Hello everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host, Niklas, and with me in the studio this time is Henrik Andersson. Henrik was here recently to speak with Cole Smead. Welcome back, Henrik.
Thank you very much. Now I ought to be a little bit more warmed up, right? I certainly feel ready to go, and I'm very excited about today's conversation, which I very much believe will be a great one and introduce some fresh perspective to our listeners.
And in this episode, we are speaking with Paddy Hogan, Head of Investor Relations at Orix. Henrik, you have followed Orix for some time. Can you give us an introduction, please?
Sure. So Orix is a Japanese corporation founded in 1964. So in those 59 years since it was founded, they have grown into global enterprise engaged in a diverse range of businesses, including finance, investment, life insurance, banking, real estate, environment, and last but not least, the original business of leasing. So Orix is actually an amalgamation of the words original and flexible, which certainly touches a nerve with me, being an owner of Fair and Friendly Acquisitions, or more known as Fairfax. The company certainly seems to have a special culture and purpose around it, where the long-standing CEO Makoto Inoue plays an important role, similar to perhaps Bruce Flatt at Brookfield, or even more pertinent for today, Steve Schwarzman at Blackstone.
And Paddy has chosen the book What It Takes by Stephen A. Schwarzman for today's conversation, which is a biography of him focused on his firm, Blackstone. We get to learn more about the founding of the firm, its challenges and successes, the corporate culture, and Schwarzman's endeavors within politics and philanthropy. A large part of the book is also about Schwarzman's views on managing people, which may not be strange, as running a business such as Blackstone entails having strong people skills. What It Takes was published in 2019, and we are delighted to discuss it with the head of IR at Orix. Here comes our conversation with Paddy Hogan. Hi Paddy, and welcome to Investing by the Books podcast.
Thank you for having me. It's a pleasure to be here.
It's great to have you on, and thank you for taking the time. Where are you located today?
I'm located in New York this morning.
And to begin, can you tell our listeners a little bit about you?
Certainly. My name is Paddy Hogan, and my role is head of investor relations at Orix. Orix is a Japanese company listed on both the Tokyo and New York Stock Exchange. And my role as investor relations is really to promote and advocate for the company without external stakeholders. I'm based out of New York, but have lived and spent much of my career in Tokyo.
And in today's conversation, we will discuss the book What It Takes. Why have you selected this book?
I think it's a great, anyone interested in finance. My background prior to joining Orix, I spent nearly 3 decades on Wall Street at sort of investment banks, most recently Deutsche Bank, and prior to that, Merrill Lynch. Anyone interested in finance or leadership, I think, can really utilize and enjoy this book. Steve Schwarzman was obviously a fantastic academic student, a great success in his early Wall Street career. And then has frankly built, arguably the most famous alternative asset manager globally.
And the book, as you said, is a biography of Stephen Schwarzman. Can you tell us a bit more about him?
Well, as I said, he's born in relatively modest middle class background, but his claim to fame is he was obviously a brilliant student. He did very well on Wall Street at Lehman Brothers and rose to an impressive level in his mid-30s, and then rather than sort of reap that success, he and his mentor founded an asset management company called Blackstone. And really, initially, it was difficult. Asset management companies are pretty simple companies to analyze from outside, but they require people, fiduciaries, to give them money and trust. And I think he was a relatively new comer to this field, and there are some lessons about his tenacity in terms of raising money and searching for that initial validation from third party or external clients, and then the great success. And Blackstone, as I said, is a household name. But so I think lots of lessons to be learned in terms of finance, in leadership, in corporate culture. And as I said, I'd recommend it to really anyone interested in finance or investing.
And I think one aspect in the book that was especially interesting, maybe for me and Henrik, is corporate culture, as we are both passionate and understand the value of that for a business. And what we get to understand is, one example is that Blackstone is really laser focused on only hiring the best people, what they deem as tens. How do you manage to employ the best people at Orix?
Well, I think every company is different, and I think as you become larger, I'm not sure if Mr. Schwarzman or his current president John Gray were on this call, they might admit as they become larger, it's hard to find tens each time. And also, a 10 in the Tokyo office of Blackstone might be different from a 10 in the Mumbai office. There are different skills, they're different, required in different operating environments, different cultural sensitivities in different geographies, etc. So I think it's important to be flexible in terms of searching for your staffing needs. I think it's important to search for a diverse roster of candidates for every position. I think it's well proven that a diverse workforce is a better workforce. It's a more innovative workforce. And I notice in recent times, if you look at the management team at Blackstone from a gender perspective, and I'm sure, although in his chairman role, Steve is less day to day, but I'm sure his fingerprints over it. If you look at the senior management of Blackstone, there are many very qualified females in senior executive positions.
Another thread that runs through the book is Steve Schwarzman's focus on succession, and I'm interested to learn about that a bit more for Orix, and not only on the top level, but actually on every leadership role, for example. How do you think about succession in your company, which is really people? It's so important with the people aspects in your type of business.
It's super important. And just by stepping back, to talk about staffing and Orix, I said, is a financial services company based out of Tokyo, but we've operations in almost 30 countries. We employ about 32,000 people, about a quarter of which are outside Japan. So we have a very diverse labor force globally. As is traditional for Japanese companies, a lot of our staff are rotated every 4 or 5 years to different departments or different geographies, and that builds and that's quite unique amongst Japanese companies, but it builds general management talent. The ultimate successor to our current CEO, Mr. Inoue, needs to be someone that has perhaps worked in different functions, different divisions, worked in different geographies. Because we're a complex company, 40% approximately of our earnings are from sort of overseas. So I think to run a company as broad as Orix with many divisions, many geographic locations, really does lead to a qualified roster of clients. While Blackstone is an asset manager, primarily using its external funds, but obviously there's some proprietary partner capital there. They're involved in a very diverse array of investments: infrastructure, private equity, real estate, direct alternative managers. If you look at our business, it's similarly diverse, perhaps more diverse. We have exposure to asset classes like they have, private equity, real estate, infrastructure, but also other things like aircraft leasing. We own a bank, we own an insurance company. How does one individual, assimilate the competencies to run a business as diverse as that? Well, clearly, I think job rotation via the Japanese format of sort of every 4 or 5 years taking on a new assignment gives you a diverse set of experiences. That's important. But then I think it's trust in your line management teams on the ground. You have, and I think there's a blend in Orix, which is sort of quite interesting, that we've realized that we need sort of almost two types of professionals. We need subject matter experts hired into insurance from outside. That person is an insurance expert. Fantastic. We also need this, as I describe them, a cadre of generalists who are general managers who can work in different departments and have perhaps better management skills, but not necessarily the sort of deep vertical expertise for a particular industry. So I would say, how do we develop that? Look, I think HR in any financial services company where the greatest asset is the people, the talent that goes up and down in the elevator, has a huge role to play. And I think it's assimilating a small, those generalist managers. They could be, in our case, probably 400-ish. And you're developing that sort of talent and pushing them to a different level, giving them a different experience. Okay, he or she was great in corporate financial services. How would they fare in sort of auto leasing in Australia or aircraft leasing in Dublin? Are those skills transfer? And I think talent development is incredibly important. And look, I think that goes into training, both internal, external training, but also just managing people's careers. And I think, again, Japanese companies benefit, and it's changing a little bit, but often from the longevity of people's careers. Many people join Japanese companies and stay for their whole career. That's great because it encourages investment on the employer's part. But I think it's also important to bring in talent from overseas, the subject matter experts that I alluded to, because that's how you keep fresh. And what I think is very interesting about Orix is the willingness to hire from outside. So if I look at the last fiscal year, for example, at Orix, about 60% of the new recruits came from outside. That's pretty unique. If you look at a Japanese company, most of the recruits that are new employees in the prior year joined on April 1st. They were new graduate trainees. Look at the board of a typical Japanese company and you will see, joined 1989, joined 1985, joined 1979 and have risen through the ranks. And that's good in terms of an individual corporate culture. But in a world where companies have to adapt, and there's a ton of external forces and changes out there, and a world where companies are competing in many different geographies and markets, I think having a sort of diverse pool of talent and a willingness to embrace best practice from outside only makes the company a stronger one.
That's really interesting. One thing that I want to follow up on is, you mentioned decentralization. I just want to understand how Japanese companies in general, how decentralized they typically are compared to maybe US companies or companies in Europe. And maybe talk about, where you are at Orix in that aspect as well.
As a company grows and builds regional offices and has an increasing amount of its business cross-border, you have this challenge of how do you manage that from headquarters? There's a certain element of delegation of authority to regional offices, to regional managers, but at the same time, you need central risk controls. It's a real balance. But a couple of things, and this is, partly why, there is a parallel with Blackstone. Orix does have very strong leadership centralized in Tokyo. There is an investment committee, so any new investment or project being considered is scrubbed at the office of the CEO and then presented to the CEO's investment committee. The CEO chairs the investment committee, meets 3 times a month. And that centralization of capital allocation is very important. I think it's not dissimilar at Blackstone, where Steve Schwarzman and now perhaps today his president John Gray oversee an investment committee. So as ideas are presented, someone can say, well, that's really interesting, but did you check with so-and-so in the London office because we did something similar, 18 months ago? And then you actually have knowledge management across the organization. And more importantly, the proposer of that project or deal then checks with the London office, and maybe a bigger or better deal comes back. And so I think that centrality of capital allocation, that centrality of the investment committee is common at both Blackstone and common at Orix. And I do think it leads to shared knowledge. It does lead to better thought out transactions and projects. But I do think, to what I said a moment ago, I think there's a balance between delegation of authority and central governance. I think head office needs to be able to run the governance functions on a global basis. But it also needs trust with its regional leadership that they are in compliance with sort of global standards, and more importantly, internal company directives and standards. But I do think the centralization of capital allocation, that central investment committee where best ideas are shared, discussed, and approved, I think is common to both companies. And I do think ultimately trust is developed. The CEO's office in Tokyo, in the case of Orix, develops trust with the track record and process of, say, our Irish division, which would handle aircraft leasing. So perhaps their limits, their delegations of authority are sort of are enhanced over time, although we're pretty consistent across the world in terms of an equity or a debt limit. But I do think there's an element of trust and communication. And ultimately, I think the regional office manager or the overseas representative needs to be proactive in communication back to head office, and that's the same for any company.
I think it gets very close to what you talked about, Paddy, in terms of really trying to teach or bring about more people by surfacing around in the organization, by learning how to prioritize capital allocation, how different businesses are run and how they are managed, what the nuances of each business. Because if you haven't seen it all, then it's tough to choose between each and every one, right? So capital allocation, I guess, is one of those things where it's hard to learn it just by sitting next to someone. You gotta learn it by seeing success or failure in each of the businesses that you are then so sort of finally appointed to run. And I guess it's hard for any business with the capital allocation perspective first and foremost to find a successor to. It could be Schwarzman, it could be Bruce Flatt, or it could be Warren Buffett, or it could be your CEO. That's the challenge, right? With taking a successful business and then making it another 25, 30 years, right?
Yes, I do think, Henrik, though, I think it's important to have, if you have consistent hurdle rates, consistent investment return requirements, that's helpful. So how do you compare investing in Indian renewables to US commercial real estate? They're very different asset classes. But I think if you're disciplined, well, we have these certain hurdle rates. What is the, over a certain period, what sort of return are you looking? And then ultimately, capital should go where it's best treated, where return requirements are visible or more visible. And obviously return is always kind of measured against the risk implicit. But I think if you're clear in terms of, this is what we're looking for in certain projects. In Orix's case, we look for a 15% internal rate of return over a 5 to 7 year period. And we'd like projects to be 10% ROE accretive, 3% ROA accretive. So, I think in the Indian renewables case, or the US commercial real estate, the individual who's bringing that project is looking at their potential returns. And that's a first, if you like, screen test in terms of, or tripwire in terms, are the returns there? And then helps to compare different projects in different geographies at the same time.
I think another part of the corporate culture in Blackstone that Schwarzman brings up is that he really, I mean, focusing on having really beautiful spaces for the offices that you have around the world. He thinks that attracts the best people, and in turn that far exceeds the cost. I mean, how do you think about this at Orix? Because I mean, me and Henrik are, I mean, used to. We like companies that are frugal, and we celebrate, for example, Tom Murphy in capital cities for his decision to only paint the part of the building that faces the road. So that's quite a huge distinction from what Schwarzman did at Blackstone.
Well, I think a couple of things. First of all, remember Blackstone, and we're talking about a fantastically successful company. So I think it is not appropriate to really criticize anything that Blackstone has done. Their track record speaks for itself. But remember, Blackstone is built on third-party or external funds. So I guess there's twin rationales for having the glossy office. One is, if you're a potential allocator, think if you're a state pension or a university endowment or an insurance company thinking of allocating money to Blackstone, perhaps visiting a very nice office and seeing, what clearly is a successful practice is inspiring, and because you're effectively you're a fiduciary in that case, be it the insurance CIO or the CIO of the university endowment, you are allocating your individual retail clients, our students, our staff, pension money. You're operating as a fiduciary. So clearly going to an impressive office may well inspire confidence, and just think of you as an individual. If you went to a doctor in a rundown office or a doctor in a very clean and shiny clinic, you'd be more encouraged and more inspired. So I think that's an important point to stress, that they are reliant on external investors, and I think having an impressive office to present to potential investors and clients probably does help. I think it's also clearly in the current environment, with people opting to work from home, perhaps having a nice office, a welcoming environment, and look, there's been lots of studies on this, I think encourages more office participation. So I note the reference to the frugal office. I think at Orix, we have moved into a new building in the last 18 months. I think it has a lot of the features of that new buildings now have, in terms of, potential mobile desk positions, nice coffee shops, a cafeteria. It's well lit. It encourages dialogue in standing up or in small cubicles and environment. So I think it's very important for the office to be welcoming as a place to bring people back. And I think we can talk to work from home and what it means. But I think also, if you're reliant on external capital, if you're reliant on investors, on clients, having an impressive office inspires confidence about the success and the durability of the company that you are. So I think it's important. So look, there's a balance between a smart, welcoming office and extravagance. So, and I would like to think Orix, as a typical Japanese company, probably errs on the frugal side of that balance. But I think if you ever have, or any of your listeners have occasion to visit our offices, they certainly wouldn't be described as shabby, but nor would they be described as ostentatious or overly luxurious. I think we get the balance right.
Okay, great. So then I think we have covered a bit on, the corporate culture aspects on employees and also on customers. But one aspect that's quite often forgotten, I think, is the shareholders, because I think if you have the right shareholders, that also impacts the corporate culture of a business. And it's I don't know what comes first, and maybe that's what we should discuss. But just look at Berkshire Hathaway and the following they have, and enforcement of really long-term thinking that they have created. I was just, when I read the book, I mean, Schwarzman brings up that at the time of their IPO, he wrote in the prospectus that the common units should only be bought by investors who expect to remain unit holders for a number of years. And I was just thinking, I mean, how do you work on getting the best investors you can possibly get at Orix that really, I mean, understand your philosophy and think long-term as you do?
Well, I think anybody doing my job, investor relations for a public company, searches and hopes for longer term shareholders who will buy into the strategic vision of the company and buy and hold the shares for a very long time. Why? Because that's patient capital. That's reduces the volatility on the stock in terms of trading. So I think whether your company is a very cyclical technology company or a new emerging software as a service company that is unproven business model wise, or a stable utility, all listed companies aspire for long-term shareholders. All public companies want that patient capital. So I think it's important to demonstrate a track record that attracts that type of patient capital. So when we think about, and look, there's many types of capital and many types of investors. And I think the world has changed. And I think investor relations officers, people doing my job, need to adjust with shorter term horizons. That could be retail investors. It could be sometimes, hedge funds are mischaracterized as, short term. Many are very long term. It is true. There's increasingly quant or factor trading in markets. So while all IROs, investor relations office, search patient capital, I think it's important to recognize there are many types of investors with many different investment horizons. And even that patient capital, which is often value driven, if the stock appreciates over time, the stock may well attract different investors. And I think there's a life cycle or life cycles in the shareholder base. Certain investors may be shareholders for the very long term. Others have certain price bands or price ceilings that if and when reached, they will be selling the shares. But how do you attract patient capital long-term investors, such as Mr. Schwarzman says that he would like at the time of the IPO? A new company at IPO is unproven as a public company. It typically is priced at a discount to peers to make it attractive on day one. But then it's really about demonstration of a track record. And Orix was founded in 1964 and has been profitable every single year since. So that's impressive. So when I meet a new potential investor or someone who is looking at Orix with fresh eyes, wow, you're ostensibly a financial services company, 8591, listed in Tokyo, and you've been profitable every single year for 58 years. That even during the years of the financial crisis, 2008, 2009, that gives me a certain confidence. Oh, I look at the dividend and it's increased tenfold over since the financial crisis. Every single year is raising. That's very good. There may be volatility in earnings, but the dividend rises each year. So I think it's about track record. And I think, you referenced Berkshire Hathaway. I think most people who are invested there are investing in the track record of the company, which has been earned over a very long time. The allocator at the pension fund or the university endowment or the insurance company wants to sleep at night, probably investing in, Berkshire Hathaway, and the track record earned over a long time helps them sleep at night. So I think at Orix, yes, we want to attract long-term capital. We want to attract patient investors who will stick with us over the time and over cycles. And we would point to our track record, which I referenced earlier. But at the same time, we think our stock is cheap, and we also think there are many types of investors. So we should, in my job, certainly entertain and be willing to speak to all types of investors. and who may have different horizons or different return goals.
Over time, a company gets the shareholders it deserves, right? I don't know who said that, but it's these quotes get sometimes thrown around, and you're not sure who said it first time. But that's one thing to hold on to, I guess.
No, absolutely. Look, I think that's probably true. But at the same time, I think there are many public companies and there are many potential investments competing. So I think a proactive investor relations strategy is good for reaching out to investors who may not know your company, and encouraging people to take a look. Investors are, fund managers, like yourself, Henrik, are very busy. You're looking at lots of potential investments on any single day. You don't have the bandwidth to look at everything. So I think to get on your radar screen, the investor relations executive, even if they are representing a company with a very long-term successful track record, needs to be proactive. I also think that the simplicity of the business model is important. I think investors buy what they understand. So being able to explain the company and perhaps compare it to other companies is also important.
When you meet it could be a new investor, it could be someone who knows you well, and you go through it's an impressive fact in terms of profitability every year since foundation and so forth, and not only through the Lehman crisis, but also the Japanese homegrown crisis in the late 80s, right? It says obviously in of itself that the culture and the discipline has been good historically. What foundations or what major pieces of the puzzle would you say that describes Orix today? What's the cultural foundation for making another 40, 50 successful years down the road?
Look, I think there's something if you read Mr. Schwarzman's book on the inside, in the inside flap, his single mantra is "Don't lose money." Orix, I'm sure, has on occasion lost money on individual projects, but we don't like losing money, so that's very important. And there is a difference. Steve Schwarzman and Blackstone are mainly investing with other people's money. Historically, Orix has been investing its own principal capital, and as a public company, it's effectively shareholders' capital. So we take a great responsibility on being price disciplined, on looking for those investment returns, not straying. We have our clear hurdle rates of return. I would say Orix is also constantly looking for the new opportunity that is adjacent to a current area of expertise. So there are many things out there, many of them led by technology, that are new, but we don't have expertise in that. But when I look at Orix, the expertise over the years has been sort of ability to price risk well and to be disciplined and patient allocators of capital in certain areas. And if we see an opportunity in an area adjacent or complementary to us, we can move quickly. And when I think about the history of Orix, there's many cases where we've been early into a new market. Again, that is, we think is it relatively adjacent to our existing expertise, so we don't think it's a big risk or a big leap. If we're not terribly certain, we'll bring in expertise or partners. So when I think about the history of Orix and the ability for Orix to, if we were having this conversation in 40 years, to still be here and be a successful enterprise in 40 years, I am confident that pricing discipline and a desire not to lose money will be very important. But let me talk a little bit about moving into areas of adjacent expertise. So when I look at the history of Orix, I like to think that with any asset class, Orix has moved from a lessor or financer capacity to then an operator capacity, and then to an investor capacity. And let me explain what I mean. Say, take real estate. Initially, we financed condominium buildings. Pretty simple. We're lending money, and we're arranging, financing for you, Henrik, to buy a condominium, and we call that broadly residential real estate. Then we got into managing those condominium buildings on behalf of, investors, and that's great. That's property management fees, etc. And then we got into the investing stage of buying and selling real estate. And it's sort of, as a lessor or a financer, initially you learn the cash flows, the risk inherent in the asset class, and then you're much better to move into an operator stroke investor capacity, able to price that risk. Take aircraft leasing, a business we've been in for over 30 years. Similarly, initially leasing aircraft, organizing the financing of aircraft. Now we manage a fleet on behalf of third-party investors. Very nice, durable asset management fees on that. But we buy and sell about 100 aircraft as well, booking investment gains each year. So that's interesting. Lessor to operator to investor. Then I think about areas adjacent. Giving the real estate example, we were domiciled and born in Osaka. So when the first opportunity came to manage an airport concession rights came for Osaka Airport, that was natural. We had hotel and real estate expertise, and Kansai International Airport in Osaka is next door. We should be involved, and we bid, and that was the first airport concession rights. But we know what we don't know, so we invited Vinci Airports of France to work with us. So bringing in that skilled operator. That is one of Orix's greatest investments. Now today, Orix is in the throes of bidding for the first integrated resort ever in Japan. It would be located on reclaimed land in Osaka. So you could have a situation, well, fantastic. Again, Orix leveraging its real estate and hotel expertise, but potential customers flying into Kansai Airport, being entertained or, for leisure activities in integrated resort, co-managed by Orix. But Orix doesn't know that much about managing a casino. So again, bring in expertise in the face of MGM, a partner. So ability to learn as a lessor or financer before becoming an operator or investor. So that's discipline, and patient, ability to move into an adjacent area, but also willingness to sort of say we should bring in a partner where we're going to work in an area where we don't have subject matter expertise. And I think the example of Vinci Airports at Kansai International Airport and MGM for the management of the operations of the integrated resort shows a good humility at Orix that, yes, we want to move into adjacent areas and we want to chase good investment opportunities. But if we don't know what we don't know, we should bring in appropriate expertise.
And when you find this potential opportunity that you believe will give you that IRR of 15% or more, I'm curious to know how you think about how you size these different bets, so to speak. Our hero Charlie Munger is famous for saying that if you find a great idea, bet big. And similarly, Schwarzman writes, "I see a unique opportunity and I go for it with everything I have." So what's Orix's take on position sizing?
I think we're a Japanese company, so we will never be so aggressive. Also, and let me give a little bit of historical context. While it remained profitable, Orix had a challenging financial crisis. It had about 40% of its assets or balance sheet assets in one asset class, real estate, and obviously real estate prices collapsed. And we had a lot of relatively short-term financing, so duration mismatch. So I think we'll be cautious and probably not bet the house on a particular opportunity. And there, I think perhaps lies the merits of the diversified portfolio. So we have 10 segments, which is often optically confusing for someone looking at Orix for the first time. But what comes across is the relative stability in earnings. So if one segment is suffering or struggling, as say in the recent COVID crisis, aircraft leasing was not a good business to be in, but some of our other more businesses that were more stable continue to drive that overall stability in earnings. So it is true. I've worked with my prior employers and trading floors, and people will say when you have that opportunity, you size your position. I think we will make big investments. Look, we just made the largest ever domestic private equity transaction in Japan in buying a company called DHC Cosmetics and it was the sticker price or flagship price was 300 billion yen. But for a company with segment assets of about 11 trillion yen, that was still relatively small. So in terms of that outsized position that would put the company at risk, no, I think we've learned our lessons, and also I think there's a prudent responsibility and commitment to the more diversified model.
Right. You could say that you're in the corner of to finish first, you must first finish rather than back up the truck in that sense, right?
Very, very true. Yes.
So another very interesting part of the book, which is mentioned a couple of times, I believe, is that Schwarzman says that Blackstone has never been a hostile buyer, and given the fact that this could be said be more part of Japanese culture rather than U.S. culture to some extent, I'd be curious to hear your and Orix's take on acquisitions and hostility or friendship.
I think it's a very topical subject in Japanese finance at the moment, because the Japanese stock market, in simple valuation terms, is relatively inexpensive, and there's been, I suppose, an increase in activism type activity or engagement investing in Japan. We Orix have taken over public companies. Daikyo springs to mind, the condominium company that used to be listed, 8840. We are currently linked with a bid for Toshiba. We are a part of the JIP, Japan Investment Partners bid for Toshiba. And we would not be, which actually, by the way, has been welcomed. That bid has been approved by the Toshiba board. So we would not want to be associated with, quote unquote, a hostile bid. Part of that is, I think, about, Orix is one of Japan's more famous brands. We've been around, as I said before, since 1964. We'd like to be around for another 59 years. And I think that type of hostile activity would not endear ourselves to our stakeholders. And most of our acquisitions have been in the private space, just simply because, a hostile takeover in the public space usually requires a premium. And Orix, like your hero at Berkshire, likes to buy cheap and sell rich. I think it's important for tenure. I welcome what the Tokyo Stock Exchange is doing in terms of shining a torch on the amount of companies that are trading at discounted valuations and telling companies that they need to understand capital allocation, capital efficiency, their cost of capital better. I welcome the increased focus by engagement or activist investors on Japan, because clearly there are some very clear cases of companies, public companies not necessarily being run for shareholders, of perhaps inefficient capital allocation. That is all good. And indeed, unfortunately, Orix also has a valuation below 1x price to book. But I would not welcome an increased sort of hostile environment, and certainly we would not be party to that. And I would say, I think what's happening in Japan in terms of potentially increased corporate activity, particularly in the private space, is an opportunity for Orix. Orix is seen as a very welcome partner. We're a household name. We know we own a bank, an insurance company. We own a baseball team. I think if you stopped 100 people outside Tokyo Station and asked them are they familiar with Orix, 99 would be, maybe first for the baseball team. So I think that type of, national profile, has been earned patiently, and we would certainly not to squander it. But I mentioned a transaction earlier where we bought a company called DHC, a cosmetics company, earlier in the year. We were not the best bid, but let me give you a little bit of background. The founder was 82 years of age. He had founded the company 50 years before. Very successful company, big online presence, but international presence too. Very well known in the sort of cosmetics, health supplement product area. And he was looking for a succession plan. If he sold his company to a foreign fund, they may look to cut SG&A, cut staff, build a company, make it more attractive from an operating margin point of view, and then sell it. That's traditionally what private equity investors do. Orix, because its Japanese private equity arm is not reliant on public money, can be more patient. It can bring solutions, real estate, staffing beyond just capital. And in this case, the founder of DHC chose to sell to Orix, even though we were not the best bid. And that's important to underline to your listeners that Orix, in the third largest economy in the world, is the preferred buyer of private assets. And that's a great, sure, there are many companies, if they were being bought in the United States, that like to be bought by Berkshire, and have that Berkshire, validation, if you like. And I think to a certain extent, the greatest challenge facing Japan is demographics. It's an aging population. It's been well written that many of these Japanese management teams are old. 80% of Japanese people work for a small and medium-sized company. We're familiar with the Japanese brand names of Hitachi or Sony or, maybe Orix. But we're not so familiar with that 80% of the Japanese population work for small companies. Orix's leasing network is 260,000 SMEs. It would be reasonable to think amongst those 260,000 that 1% are managed by a 75-year-old or older executive. That's potentially a great pipeline of companies that are looking about and wondering about succession. And as I said, the DHC example gives me, great confidence that as an opportunity for Orix in terms of CEO succession or domestic private equity, it's very exciting and filled with potential. And we are potentially a solution to that succession issue. And in the case of DHC, Mr. Yoshida has left. We promoted the number 2. We sent some Orix staff. We brought in a chairman who was formerly at Polar Orbis, who would give some operating and experience in the cosmetics world. So very exciting. And I think, again, it's the opposite of a hostile takeover, isn't it? It's being the sort of preferred solution provider for a really big problem in Japan, that of demographics.
I think you hit on something that really gets me going, and that's, in Sweden we have a lot of holding companies that buy for keeps. They buy without having an exit strategy, and in the book we also learned that Schwarzman describes how he wanted to diverge from the traditional PE model to invest in companies without an exit strategy. I'm curious to know your views on that and how you work at Orix.
I think, again, for domestic private equity, we are using shareholder capital, Orix principal capital, if you like. So you can be really patient. You can buy and hold. However, listening to what the TSE have been saying, we're a public company, so there's a balance between being efficient in capital recycling and recycling of capital. So we are lucky that we can buy with a longer term view than, say, a fund who has set up for 5 years and needs an exit to monetize certain gains. There are certain businesses we're in that have been in for a very long time, and unless dynamics change, we may still be in those businesses. But I think we can't ignore market dynamics. Industries change, pricing changes, and look, we always need to be asking ourselves, just as we might have been the preferred buyer, are we the best owner? So I give you an example. We had bought an accounting software company called Yaoi about 9 years ago. It's very like Xero in Australia. It does accounting software for very small companies, typically 3-4 employees. We had this domestic leasing network, 260,000 SMEs. We thought we could sell accounting software to them. It would be natural. But many of our SMEs in Japan can be anything from 2 people to 2,000 people. Many were a little bit larger, a little bit more sophisticated. And the synergies that we'd hoped for didn't necessarily come through. Then in the sort of 2019, 2020, 21, obviously there was great excitement about software as a service type companies and many new listings at very high valuations. And we were offered an extraordinary price by a US fund. So here, a business that we bought with a strategic vision, didn't necessarily realize the synergies. We're probably not the best owner, and there's a premium pricing bid. And in November 21, we entered a memorandum of sale, and our timing was probably very good because probably accounting software companies peaked around then. Yeah.
Great. And as this is a book podcast, we like to wrap up with the questions about reading and writing. And we believe that books have something that you can't really get from newspapers, and that is knowledge that is able to stand the test of time, so to speak. And so I wonder, what are the reading habits at Orix like?
I can't really generalize. I mean, look, I think I can't generalize for the company, and I think every individual is different. I do think that we're a financial services company, very diversified. We should clearly be looking at other companies and other industries and trying to learn lessons. But as I said, I don't impose reading. I impose on my colleagues and would desire my colleagues to have an inherent ambition and desire to be aware of changing markets and leadership lessons that can be learned, as you say, from reading. I loved this book that we started our conversation about. I would encourage people to read books. We're a financial services company that really is more a collection of operating companies. We've sometimes been compared to Berkshire. We've been sometimes compared to Macquarie. I think there are commonalities with Blackstone in terms of central leadership and central capital allocation. But I would encourage people to read books that would help them to do their job better. On a personal basis, I read a lot of leadership books, a lot of business books, and particularly, actually, I find lessons in a lot of my own game is tennis. So I read a lot of books, biographies about tennis players and the focus that is required to win. Lots of preparation, lots of training, single-minded focus on the goal, but also cognizant of the team structure that supports the individual.
Paddy Hogan, thank you so much for coming on Investing by the Books podcast to talk about what it takes and the investment style at Orix. Do you have something more you want to add before we finish up here?
No, I'm very, very flattered and pleased to be invited. I think many of your listeners may not be that familiar with Orix, but having listened to this podcast, we've piqued their curiosity, and if any have questions, I'm sure you can direct them towards me.
Perfect. Thank you so much, Paddy.
Thank you. Have a good day, guys.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.